might get started. We've got a bunch of people in here. Hi everyone, welcome and thank you so much for joining us on today's webinar. For those of you I haven't met before, my name's Ryan Dobrick. I'm the Director and Principal Financial Planner at Liberum Financial. So a year ago, the global economy was locked down. Businesses endured a window of uncertainty without government support, and a COVID-19 vaccine didn't exist yet. The future was bleak, yet most investment markets spectacularly rebounded, some breaking new records. So how are things sitting now, and what should you be looking at for when it comes to your own portfolio? To help answer this question and shed some light on what's going on out there today, I'm joined by Dan Miles, Managing Director and Co-Chief Investment Officer of Innova Asset Management, the research and investment house behind our investment offerings. If there's anyone well-versed in understanding what's happening out there, it's Dan. Dan has led Innova since its inception and is responsible for overall portfolio management of Innova's managed account portfolios. He also oversees the design and refinement of the company's quantitative modelling processes based on Innova's unique approach to managing investment risk. You might have seen Dan on Sky Business News, and in fact he was just last night was on 7 News. He's an active contributor to media discussions on issues affecting the investment and advice communities, and has co-written a number of research reports on portfolio construction, risk management, including partnering with global actuarial firm Milliman. Dan, thanks for joining us. Really keen to hear what's happening out there and how we can ensure that our investments can weather what's on the horizon. Before I hand over, just a bit of housekeeping. There we go. Everything we're chatting about today does not consider your personal circumstances and is in general by nature. I do invite you to reach out to me afterwards if you'd like to chat specifically about your situation. I'll share my contact details at the end. Also, I'd like to encourage you to ask questions throughout the question by using the Q&A feature. You'll see the Q&A icon at the bottom of your Zoom window. I'll keep an eye on these as we go through, and we'll answer as many as we can throughout the session. And if we don't get to them, we'll have time at the end to go through. Shortly after the session, we'll email you a recording, which you're welcome to share with others that you think might be interested. And on that note, I'm going to pass over to Dan.
Thanks very much, Ryan.
Worries won't be a sec. Yeah.
Okay. Right. Thank you very much, Ryan. Appreciate the opportunity to talk about this. It's a very interesting time at the moment. So the topics we'll cover, as you've mentioned, we'll talk about some of the macro issues to watch, what's going on in the globe, and in particular, where a return is going to come from now, because as you mentioned, there are a few different markets that have hit all-time records. And I made a comment on the TV program yesterday where I said, look, no one knows what the terminal value of their investment is going to be, but if you work your way backwards and you've got an idea of the price, the higher the price that you pay for it, the less return you're going to get. You know, it's very simple, it's very intuitive. And given where valuations are, so the price of stocks, bonds, and other instruments versus the cash flows associated with them are extremely high, means the forecast level of return has to be lower because you are paying more for those assets. So I'll go through our outlook and how we think you can actually generate solid returns even in an expensive market. Because that's what we do. And some of the trends to watch in 2021, I published a paper on that, as you can see, that we'll talk about at the end. So, you know, cryptocurrencies, you know, are we in a bubble? And if people would like to talk about either the Australian market or the Australian economy, you know, which are actually two very different things, even though market commentators would have you think they're the same thing, I'd be more than happy if we've got time to have a conversation about those as well. So mentally, I'm in a very funny space. Performance has been strong and in particular over the last 12 months, but also over the longer term. I mean, we've got our 9-year track record there of consistently outperforming our peers and the peer set. More pleasingly than that, though, which is not on the screen here, is that we were either the top or in the top 2 or 3 performers in the COVID sell-off in March. Even more pleasingly, again, is that the other guys who are up there in the top in terms of the sell-off, this subsequent 12 months, they're right at the bottom. And the guys who are right there up at the top with us in March of 2020, they were at the absolute bottom. And so we've managed to generate what I believe to be a very appropriate returns, but we've done so without taking excessive risk, which is what you're paying an asset allocator to do. But given the returns of the last 12 months, up to 28, over 30% in our higher, more aggressive portfolios, the price you're paying is now much higher, and there's a hell of a lot of uncertainty out there given we've got a new US president, how much of his fiscal stimulus package will be passed through and in what format. We've got continuing trade relations with China becoming questionable, changes in supply chains, and we can all see what's happening with COVID in India. Does that mean that something will occur at a later date? So there's a lot of uncertainty about it. And so that combined with forecast returns being lower, you have to ask yourself where to from here, because it's great to have had strong recent performance, but lower expectations of future returns are inevitable. How are we going to go about navigating that? So the main macro issue we see around the world right now is not actually geopolitical or virus related. It is that valuation related component. Obviously, other risks exist, as I've just talked about. But if we take just the main asset classes and use our proprietary forecasting model over a 10-year time horizon, which we have a lot of academic and practical research to back up the efficacy of it, and we've tested the efficacy of it, and it's actually very good. If you're investing in just simple mainstream asset classes, they're not particularly inspiring. Japanese equities at 5.5%, emerging market equities at 5.5%, Australian equities at 3.6%. These are not the returns you expect from equities. And bonds yielding 1 to 2% is not particularly attractive either. If you're only going to be getting a percent or two more out of your equities. In regards to the geopolitical environment, the fiscal deficits that we've seen around the world, there's no clear path out of this. The clearest path out of it is actually inflationary and increases in taxation. The central banks and governments around the world would like a higher level of inflation, but they do not want too high a level of inflation. We believe their number is somewhere up to 4%. Above that, there is evidence to show that it becomes quite destructive, but up to 4% can be tolerable. But they will also need to, but nobody's going to want to go into an election cycle on the platform of increasing taxes to fix a fiscal deficit. And we've already seen the Australian government say that when unemployment reaches a level sustainably below 6%, we'll start looking at reducing some of our spending. At an unemployment rate of 5.6, which is what we are now, I'd say we are comfortably below that 6% level. They've now changed their number to 5%. So, let's see what happens with the budget and where things go to from here. But as I said, I think the main concern is that people are overpaying for assets, and you just need to jump onto any trade-related platform where people are having discussions, and the fear of missing out is as strong as it's ever been, and that includes during the tech bubble back, from 97 to 99. So how do you get out of this? How do you get around that? Well, Innova have an approach where we don't just invest in those main asset classes. That's not what we do. We take those main asset classes and we break them down into what their causal drivers of return are, because they're not just the market. They are things such as value premiums. They are things such as a premium for quality. We look at other forms of fixed income such as corporate loans and investment grade bonds, and we're also prepared to allocate regionally, so to areas like emerging markets in Asia, which are not mainstream allocations. We are prepared to allocate to in a sensible fashion, given the amount of risk associated, and even at a sector level as well, whether it be the energy related sector or other areas such as that. When you take that on board and you use the same forecast levels of return, the forecasts for certain areas, I haven't included them all here because I wouldn't be able to fit them all on 4 pages, let alone 1. You can see that there are some numbers that are a lot more healthy that you could put together into a portfolio that will generate you a reasonable return above inflation or above the cash rate. How much above? Based on this simulation that we ran, we took our high growth portfolio for those who are in a more traditional style portfolio, and we took our aspiration portfolio, which is one of our risk defined portfolios. And you can see that there's a doubling in the potential return simply by being more nuanced and spending more time on the research and analysis of being able to allocate to other areas that are not necessarily mainstream, because those are the assets that have become prohibitively expensive and you are unlikely to generate a decent return from in the future. Now, that more nuanced approach and proactive approach to asset allocation does not come with additional risk. Everything we do, we are risk managers. Everything is about the risk associated with it and not breaching a threshold level of forecast risk in any of the portfolios. And these simulations where, the high growth is at about 5 and the aspiration at about 5.5, people may think that that's not overly compelling. It's a lot better than the 2.5 that you would get if you just passively allocated to mainstream markets. But it also assumes that there's no value add from our proactive asset allocation and rotating into cheaper assets as they become cheaper, and getting out of assets as they become more expensive, which we have a history of. And I could cite 3 or 4 examples, but we're going to be publishing a paper that you can read up on and refer to if you need to, or I can go into more detail about those trades that we made if we have time later on in the presentation. We will have more time later on in the presentation because one of the things that I was asked to talk about was the main trends in 2021. A colleague went to an industry presentation, and the fund managers were talking about what are going to be the main trends of 2021. I wrote a paper back in 2017, published it in January, and said forecasting for the next 12 months is a complete and utter waste of time. I can make that paper available. I believe it's up on our website, if not, because it's now more than 4 years old. I'm more than happy to send it around. And whenever people ask me what are the main trends going to be this year, my response is ask me in December, because that's when I'll have known what they were, because you really can't predict what is going to happen. And I don't think anyone can argue against that, given what has occurred over the last couple of years. But there are 3 kind of areas that are quite prevalent and are spoken about, and I think are very relevant to thinking about and talking about. The first one is markets in bubble territory. I've already said that there were things that are very expensive. we believe that the US S&P 500 is in bubble territory. I put here what the price to cash flow ratio is. So I talked about, price to something being a ratio. This is what it has looked at throughout time. It's now more expensive than it was in the dot-com mania and in the GFC. There are other valuation metrics. There's a very popular one that's called CAPE, or the Schiller PE ratio, where instead of looking at just the price to earnings, which is, I'll be frank, is pretty much useless, you take 10 years of a company's earnings and you average them and then look at the price versus that. We have data for the S&P 500 back to 1882, and this is only the second time in history that that ratio has reached 37. The only other time was the tech bubble, which it got to 44. The next closest was prior to the Great Depression, when it got to 36. And each and every time, each of those three times, it has reached a level at or similar to this. The subsequent 10-year returns were either dead flat or they were negative. So we would then say, yes, we believe the S&P 500 is in a bubble. However, it's in a bubble because of particular areas, and I don't think I'd be telling anybody something they don't already know, where it is areas such as new tech, where people are paying absurd amounts of money for companies that don't even generate cash flow and don't really even have a business plan as to how they're going to generate cash flow into the future. Not just new tech, even old tech, technology companies that are well and understood, in this region as well. Those are the areas that we're particularly concerned about. If you want to talk about new tech in Australia, because we're Australians and we have a home country bias, and we like to invest in Australian companies. If you just look at Zip and Afterpay, you would have to assume a level of growth of those companies into perpetuity that would essentially mean a complete saturation of the entire population and then some to justify what people are currently paying for them. So we think that they are in bubble territory. But there are lots of areas that are not in bubble territory. Value stocks, value being defined, well, there's lots of definition of value, but just think of value as stocks with low valuation multiples, whether it's a low price to cash flow or a low CAPE ratio or a low price to book. Those are not at all expensive. They're not cheap by historical standards, but they're not two standard deviations away from their average. They're at about average. So areas within the discretionary area, areas such as resources, materials, other cyclical sectors, those are not trading at historically high valuations. And funnily enough, those are the stocks that currently make up the various value indices around the world, because they're not trading at ridiculous amounts. And people may not be aware of this, but you can check this for yourself. If you buy a basket of resource companies, you'll get a dividend yield that's higher than the banks right now. And that's quite a phenomenal statement, given that the four big banks in Australia, one of the main reasons why self-managed super fund investors have held the banks has been for their dividend yield. Resource companies have never issued dividends. They've had a habit of, whenever they made profits, they would go out and make silly acquisitions and try to build empires, which is why they would be so incredibly cyclical. This time around, there is some merger and activity going on in both the material space and in the gold miners and producers space, but of nothing like what it was previously. Now, I can't remember the stock off the top of my head because I don't specifically cover stocks, but I believe it's Newcrest, has a 50% payout ratio at the moment, and that they are planning on maintaining that into perpetuity. So, 50% of their after-tax profits they will be returning to shareholders. So to be getting dividends out of those areas implies that they are not overly expensive.
Do you see that as a long-term trend, the resources paying more dividends into the future, do?
If they are rewarded by increased capital from investors, then yes, they will. And at the moment, they are being rewarded. But on top of that, they were very harshly punished after 2011. And that is still in the minds of, most of the senior management, even though some of the senior management have turned over. Whilst they turn over from resource company to resource company, 7 out of 10 times. So I believe it is a trend that will stay, but nothing is a guarantee. So that may change. There are lots of other areas. I mean, Europe at the large end of the market cap area we're particularly concerned about because of the exposure to COVID and having open borders. However, the mid cap area and the cyclical area we think is actually particularly attractive because, I mean, if you just take financials as an example, banks make money by borrowing short and lending long as their primary business, right? That's very hard when you're borrowing short at a very cheap rate, but when you lend long, your 10-year bond yield is negative. So how much can you lend out at? You can't lend out at much at all. Banks need a positively sloping, what's called a yield curve, which is the yield on instruments of different time horizons. So the longer the time horizon, the higher the yield, and that leads to an upward sloping yield curve. They need that to be profitable. And given that we have already had since February a rise in the long end of that yield curve, and I believe that I don't think that's going to be going out to 4 or 5% anytime soon, but at a 2.5% level instead of at a 0, those banks suddenly become more profitable, and you're paying for them assuming that they're never going to generate a profit ever again. So they're relatively attractive. We're quite partial to Asia and emerging markets simply because of the underlying growth story and the quality of the businesses in those areas. If you buy those quality companies, are as high quality as any company that you will find in any developed world. Some people might argue that you could look at, you pick a couple of names and say, those names, they're not as high quality as AliExpress is not as high quality as Amazon. Well, no, it's not. I don't say that it is, but instead of paying 150 to 200 times earnings for it, you're paying substantially less. Now, I'm not saying go out and buy Alibaba or AliExpress, but that is just an example of the companies in those regions that not only can you get high quality, but you have a natural growth, you have natural economic growth and increasing prosperity amongst the populace that will lead to increased corporate profitability, and you don't have to pay historically high multiples for it. And so therefore the forecast level of return for it is high, and the risk associated with it is somewhat mitigated because you're not overpaying for it. Now, clearly there's geopolitical risks in Asia. That's why you buy a diversified portfolio. You don't concentrate in one company. You're never going to see an allocation to Russia in our portfolios. But a portfolio of those assets, they're not in bubble territory. The big one, Australia. Is Australia in bubble territory? No, it's not. Are areas of it in bubble territory? Yes, they are. We have a specific value bias, and we've been increasing that value bias. That has paid off, but we have hedged that bet with a quality bias where we can get it as well, because if value goes on the nose again like it has been for an 11-year period, generally quality does very, very well. The other reason why, actually, I'll talk about this in a second. So we've got this value bias with the quality hedge against it, just in case we're wrong. But the last time that the discrepancy between value style investing and growth style investing was this high, value had underperformed for 14 years prior to it, and at the moment it's underperformed for 11 years. It made all of that underperformance back and then some in only 13 months. So it is worthwhile to keep in mind that these trends can change very, very quickly, which is why we have exposure to them, given that they are attractive at the moment. We're not banking on them, suddenly returning massive amounts in a short period of time, but, they're there. The gold miners and producers, we don't think are in bubble territory. If people think the price of gold is not worth $1,700, it's only worth $1,400, they're still highly profitable companies, and they are paying out dividends, and they are not going out and mergers and acquisitions. And if I think about the fixed income markets, I take a barbell approach. The AAA rated end of the spectrum, which is normally reserved for large sovereigns such as the US and Australia, but there are also AAA rated companies. I don't like bonds in that area because the spread on offer is not sufficient. And even if you look at the floating rate notes that are AA rated, so floating rate means that they're not fixed coupons, they're floating coupons, so they have no interest rate risk. The spread on those, or the spread above cash, the amount you get over cash on those, is now only a couple of basis points higher than it was in 2005 and 2006. So I think that end of the spectrum is not particularly attractive. And I detest the sub-investment grade or junk bond area of the market, because you are not getting paid even 1/3 of the premium that I believe that you should be getting paid for the risk of default in those companies. And given the incredibly high historical default rate and low recovery rate, the recovery is if you have a default, you can recover some assets. There's very little to recover. Getting a 3.5% return over cash for those, no way. If it was 9, I would be looking at it and may or may not allocate to it. I would much prefer it to be 11%. At 11, you would probably see us allocate. Where we find attractive is right in the middle, is right in that sweet spot in the middle, where we like bank loans. Loans are different to bonds. Loans are where a consortium of loan providers, well, when you've got a mortgage, it's a loan, but it's a consortium of providers that have very specific terms that are given to the person that they're lending to, and they have very strong covenants to be able to recover assets, and they have a huge amount of protection for the loans in Australia, because here in Australia, the protection sits with the lender, not with the borrower, which is the reverse in the US. And the corollary of that is here in Australia, if you default on the mortgage on your house, the bank takes your house and things don't go too well for you. In the US, everybody heard about, if you can't afford your mortgage, all you do is put the keys in the letterbox and walk away, and there's no recourse. There's no recourse back to you at all. You don't need to pay it back. It's kind of the same in that loan market. To a lesser extent, it is the same in the corporate bond market, and even in the structured credit market. And I know people don't like the idea of structured credit. I don't either. There is one form of structuring that I'm reasonably comfortable with, and that is the residential mortgage-backed securities, not CDOs. CDOs were residential mortgage-backed securities where they took all of the junky components, the really bad ones, and combined them together, made up fictitious assumptions of them being non-correlated, and therefore they were higher grade than what they were, whereas they weren't. They were rubbish properties. It doesn't matter how many of you put in the portfolio, they were all junk. In that RMBS space, there's, in the A-rated space, I think that's kind of the attractive area of the fixed income spectrum. I was talking about value equities before. One of the other reasons why we are using value in some of our strategies, we're hedging against it obviously in a holistic sense, is this concept of inflation. Is inflation set to return? Value stocks, by definition, will give you a hedge against inflation because people are not factoring in corporate profits out to, out for the next 20, 30 years growing at 20% per annum. They're only pricing for the next 2 years and valuing the company based on that. And so they're not as sensitive to inflation. We don't see inflation returning anytime soon. We were talking about the risk of inflation in December, and I had a few people call me and say, why are you talking about this? No one else is talking about this. And we took in some of the inflation exposure out of the portfolios fortuitously on the 30th of January. And then from the 2nd of February to now, you've seen anything with exposure to inflation get hurt. And in fact, the 12-month number for government bonds is somewhere between -5% to -4% for the last 12 months. And you don't expect to lose money on government bonds, especially not in a 12-month period. So we don't think inflation is coming back anytime soon because there is still an enormous amount of capacity in the economy. But remember, central banks and governments actually want higher inflation, and there is an unprecedented amount of fiscal stimulus that is being released at the same time as an unprecedented amount of monetary stimulus, whereas before all we had was the monetary stimulus. We now have both. So that could lead to inflation, but I do not believe it will occur in the next year or two. I think there is still too much slack in the economy for that to occur, but it is definitely a risk and is certainly something that we have taken measures against and that we will be proactively managing. And the last one is cryptocurrencies, everybody's favorite.
On inflation. So I get asked a lot what we think rates are going to do. So with inflation being low, you don't see interest rates bumping up here in Australia for the next couple of years?
No, I don't see interest rates being bumped up anywhere anytime soon for a couple of reasons. One, because of the amount of debt that corporates hold is at historical levels. And if they raise interest rates, when they try to refinance that debt, they may not be able to afford it, and that will completely crunch any kind of economic recovery and drive things back into a recession. Second of all, quantitative easing has actually given, and I don't know if they've switched onto this yet or not, but that's actually given policymakers a tool to deal with inflation without having to raise rates. They can reduce their quantitative easing, and that will suppress inflation because it will reduce the amount of liquidity in the system. It will reduce the amount of turnover in the system, and that, I believe, will be their first port of call. And once they've unwound their quantitative easing, that's when they would consider raising rates. So based on that, I don't think rates are going to be raised anytime soon, and I think that's a fairly logical argument. But I like anything, I could be proven wrong, but I think it's a fairly common sense and reasonable argument. But let's see.
And another question. So another question I get asked all the time is about residential property and house prices, especially up here in Queensland. COVID, the demand, has been through the roof with people like yourselves moving up to a better state. But
moving up.
But so with interest rates staying low for longer, do you see house prices staying, keeping values up there at the moment, or how do you see that play out?
I'm no expert on valuing residential property, but I don't think prices are going to move, but I doubt they will continue to increase at the rates they have been growing at. You talked about, especially in Brisbane or in Queensland. My cousin has worked in the residential property sector, not as a real estate agent, but he's also worked as a property developer for his entire career. And I asked him about what it would cost for an equivalent property to my own in Queensland, and it was half what my property was recently revalued at. Just for full disclosure, we got our property revalued because I think the price of residential property has gotten to such an extreme. I can't short it. the best thing I can do is sell my property and find somewhere that's far more reasonable to buy, and I'm absolutely doing that. So in September of this year, I will be moving. So in the next 4 months, we'll be selling our property, because when I got that revaluation, that was before we had done any renovations on our house, and the value of our property had increased 50% in less than 18 months.
That in Sydney, by the way, I didn't mention that.
Yeah, sorry?
I was just telling everyone that you live in Sydney. I didn't mention
yes.
that.
Yeah, sorry. So yes, so in Sydney, not in Sydney City. I live in Turramurra, so 25-minute drive from the city. But if you tack on the what we've done with the renovations, and we've gone around and looked at auctions, and we haven't been able to count less than 100 people at every auction that we've gone to, and the auctions that we have looked at in our region have all gone for 500 over the offer, the initial offer price that was put forward. So, I'm not factoring that into what I consider my property to be worth. If it's $500,000 more than what I think it is, above that valuation that came through, I would be ecstatic, but I would also be very scared because I don't think property prices are going to move anytime soon. But with people taking out mortgages at incredibly low rates, we're not going to have low rates forever. QE will eventually be unwound, and rates will have to normalize at some point in time. And people are not being prudent in the borrowing. They're borrowing as much as they are allowed to borrow because debt is so cheap. If the property market then turns, things could be quite bad, which is why I'm looking at it saying, look, my property, I could be making a huge mistake. It might increase in value by 15% year on year, but at the end of the day, it's a lifestyle asset. It's not one of my investment assets, but I can't help but put an investment lens on it because it's ingrained in my DNA, and I just can't. I can't not see somebody prepared to take an asset that I own off me at what I think is twice what it's worth. If someone's going to pay me twice what I think one of my assets is worth, I know where I can stick that money elsewhere, and with far greater security, far less risk, and with much more potential upside.
That makes sense, Dan. That's awesome. Do you want to run us through cryptos? Yeah,
look, I'll be very quick on this because I don't pretend to be an expert. It's everyone's favorite topic, but do you notice that people only ever talk about it when it's really expensive? I was on Fox in late 2018 when crypto was at 18,900, I believe, and I put up a chart of the anatomy of a bubble, and I overlaid that. And if you can see my cursor, I overlaid that where this first peak is, and I ran it back to 2014, and there's actually a couple of bumps in there that you can't see that line up perfectly with the chart called the anatomy of a bubble. And if you get a chance, just Google it, the anatomy of a bubble, it'll come up. You'll see exactly what I mean. Then obviously there was a 75% correction that happened shortly after I said that on the program. So I was very lucky in my timing. I don't pretend that I can time these things. And we're now at 70,000 Australian dollars, or we got to 80,000 Australian dollars for cryptocurrencies. Look, they could be an asset in the future. We don't believe they're an asset at the moment because, one, we don't believe they classify as a currency. They're far too volatile. Two, they're not backed up by any kind of guarantee. Paper currency isn't backed up by anything anymore either. You don't have to have gold reserves in the bank, but governments have the ability to tax the populace, so they can generate income to fund their spending if need be, and so can guarantee the currency they provide. So we don't see it as a currency. It could become a commodity. However, It confuses me that there's billions upon billions of dollars of wealth invested in something that hasn't created anything. It doesn't do anything. Like, you know, if Amazon's expensive, or if Tesla's expensive, or if Apple's expensive, they do stuff, they provide stuff. It doesn't do or provide anything. So, you know, even commodities, I mean, the commodities have a use. So it could become a commodity investment like gold, whereas we don't see gold as a commodity, we see it as a currency. But, you know, the reality is that it was developed so that trading could occur off ledger, and governments can't monitor what you're doing with your trading. You know, it scares me, the figures that I see of the amount of cryptocurrency trading that occurs on the dark web. And we know that governments want greater control and greater understanding of where our spending is going. This is the antithesis of this. This is the antithesis of what every government wants. And so the government has the power to legislate it completely out of existence. They could legislate and completely ban its use. Absolutely. Now, I don't think they will. And the more and more that people use it and utilize it, and the more institutions that kind of give it backing, and the more reputable custodians are prepared to hold it, I think it'd be harder for them to legislate it out of existence. So that it probably won't happen. But I don't think the probability is zero. So therefore, the probability being zero and the price of it being where it is, to us, the risk is too high right now that we would consider it as something that we would put in our portfolios. And there are other issues with it as well, because if we were to put it in our portfolios, how? You know, it's not on any platform. You can have it on your own computer, but then it's not in the portfolios we run for you. You can do it via a trading broker house like a CoinTree or a CoinJar or something like that, but you have no idea if they're around next week, and you have no idea if they go under whether you'll actually get your cryptocurrency back, because the custodian may not provide it to you, or they may go out of business. So I think it's a phenomenal invention. Triple entry accounting, I think, is a phenomenal invention. And I firmly believe that currency in the future will be based on this technology. I'm not convinced that the coins that are out there at the moment will be the coins that are that currency, though. I think they are more likely, well, I hope that they are currencies that are developed by governments, and we already know that there are a number of governments doing this. The US is doing this, China is doing this, Russia is clearly doing this. I would worry if someone like Facebook got Libra off the ground, because all of a sudden Facebook becomes the government and knows everything you're doing and spending, and they already know just about everything you're doing and you're spending, but they can now track everything else. I think that could happen. It could be a Facebook, it could be an Amazon, it could be an Apple. I just hope it is not. But I do believe that, you know, we will see some form of currency built on this technology in the future. I just don't believe that it's the ones that are around at the moment.
Thanks, Dan. We've actually hit our time limit, so I really appreciate all your insights there today. Yeah, it was very interesting. I'll just get you to switch back to me, host, and I'll wrap it up. But thanks for that, Dan.
Yeah, sorry, I ran a little bit over time.
All good. It was very interesting.
Okay, let me hand over control.
All right. So thanks everyone. There's no further questions there from anybody, so I'll wrap it up. As mentioned, if anybody would like to discuss anything we've spoken about on this webinar today, further, please don't hesitate to contact me. As mentioned, we'll be sending out an email with the recording of it, so feel free to share with anybody that you'd like. But appreciate your time. Thanks, Dan, and look forward to catching up with you all soon. See you later.